Afternoon, good evening to someone, and to some of you, good morning. Dear students, alumni, and guests, my name is Grażyna Rębielak, and on behalf of Warsaw University of Technology Business School, I would like to welcome you to today's inspirational lecture very warmly. I want to welcome students and alumni of our university, Warsaw University of Technology Business School, and also guests of our partners. The University of Salford in Manchester, Pål M Graduate Management School Politecnico di Milano, Goa Institute from India, Baltic Management Institute in Vilnius and Brussels, HEC in Paris, the Management Center in Innsbruck, and Zikling School of Business, Baruch College, New York City University. Today, the inspirational lecture will be delivered by Dr. Pål M, representing Salford Business School in Manchester. Dr. M is a senior research fellow at Salford Business School, University of Salford, Manchester, specialising in financial inclusion and microfinance in a developed world context. He serves as an independent expert for the steering group of the European Code of Good Conduct for microcredit provision and hosts the Innovation in Financial Inclusion podcast. The topic he's delivering tonight is there a right level of financial inclusion for households? A critical review of existing theory and evidence. Soon you will also get invitation from us for another series of lectures. But now I want to wish you a good time with Dr. Vic. After the lecture, you will be invited to ask questions on chat. And I think that's all for me for tonight. So, Pål, you are more than welcome to start your lecture.
Well, thank you very much, and thank you for that introduction. I'm just gonna share my screen, which hopefully you are seeing now. So, good afternoon, everyone, and thank you for this opportunity to come and present to you here today. What I'm going to be exploring in this paper is whether we can have too much financial inclusion, so too much access to financial services. And the title of my presentation is The Right Level of Financial Inclusion for Households, a critical review of existing theory and evidence. So over the past few years, the past few decades even, there's been a significant shift away from cash to digital. In this presentation, I want to explore the impact of that shift from cash to digital or electronic money management on household behavior and outcomes. And I want to particularly draw on the discussion of the financial inclusion literature, and on the literature that looks at different payment methods. I'm going to be using the terms digital and electronic fairly interchangeably in this presentation. The main point I'm making is that these are less transparent and less salient payment methods, and I'll be explaining why that is significant in a little bit. So for the remainder of this presentation, I'm going to be giving you a little bit of context and statistics around the shift from cash to digital or electronic transfers and payments. I'm going to be talking you through some of the key empirical and theoretical insights from the literature around financial inclusion and payment methods relating to how that shift might affect households. And because I don't feel that these literature sufficiently deals with this issue, I will outline an alternative conceptual model for how we might theorize the impact on household behavior and outcomes. I will then end by concluding with some policy and research implications. So there's been a significant shift from cash towards digital and electronic payments across the developed world, but also across the developing world. There's been a shift to payment of salaries electronically. So the overwhelming majority today are paid our salaries into our bank accounts. We receive our welfare. For those of us that receive any benefits or pensions, you receive that typically also electronically. So many governments across the world have introduced digital mandates for paying welfare benefits into electronically. For example, in the US in 2013, they introduced electronic payments for social security payments, and in the UK from around 2003 to 2005, child benefits were being paid into bank accounts and electronically. Utility companies, service providers, they are also wanting their customers to pay electronically. And we've also in the UK and I think also across Europe seen an increase in card-only businesses. So if you came to visit us at Salford Business School campus, you would, at the main cafeteria, you would have to pay with the card. So this has really led to a significant increase in digital payments and in ownership of bank accounts. So across the US and the EU and Europe, account ownership has risen to near universal levels in the past few decades. And I think this is probably going to be fairly similar across other developed countries, and it's also rising in developing countries. So this chart shows the percentage of the adult population in the US and some of the largest countries in Europe between 2011 and 2021. And you can see that Italy and Poland saw a significant increase in bank account ownership to around 90-odd%. US, UK, Germany, and France have been persistently around sort of mid to late 90s. If we look at perhaps a country with slightly lower GDP per capita, you can also see that Romania has had a significant growth from a fairly low base. And this is significant in the sense that it involves millions of people. So according to the European Savings and Retail Banking Group, something in the region of 18 million adults in the EU have become banked in the last 4 years alone. And this chart in a way hides the significance of the shift, because if we go back historically, if we look at, for example, in the UK in 1967, only 28% had a bank account, so just about a quarter, and that rose to 45% in 1975, and by the late 1990s, that increased to 80 to 85%. So a relatively recent phenomenon. This shows the volume of payments in the UK, and but I think it's going to be fairly similar across a lot of developed world economies, including European countries and the US. We've seen a significant rise in debit card use and other electronic payments, and a significant fall in cash. So cash has gone from being, 20 odd billion payments to maybe around 6 billion, and reverse debit card has gone from being about maybe around 7 to nearly 20 billion. So that has been sort of another significant shift. Now that's the rise of the increase in bank account ownership and use of a digital payment is significant because it really has heightened the need for owning a bank account and also the consequence of not having it. So when the majority did not have a bank account, it didn't matter so much whether you had it or not because there were lots of payment methods used. But now bank accounts and digital payments are becoming the norm or the standard payment, and therefore precondition for accessing employment or for even going to certain shops and paying for goods and services. So it's becoming more important. So really, not having financial services exacerbates poverty and social exclusion. In the UK, we have a concept called the poverty premium. So it essentially means that predominantly low-income households that don't use banking services to pay for goods and services, but use cash and other means, they are essentially paying a premium. They're paying more for goods and services. So this development does really underpin the emergence of financial exclusion as an issue. So the inability to access financial services is sort of considered to be an exclusionary issue in the same way that social exclusion was in its time. And there's been an increase in policy initiatives and research focusing on this topic. And just for clarity, when I talk about financial inclusion, I refer to access to ownership and use of formal financial or banking services. So financial inclusion is quite often presented as a very progressive agenda, which is all about including more people and very focused on poor people, or even just sort of a common sense practical policy that people need bank accounts and we just have to provide and make sure that they have access to that. But actually, it's not a neutral, or I would argue not perhaps even a wholly benign policy agenda, but it's intimately linked to this notion of a modern welfare state, whereby citizens are expected to cope with external shocks and life cycle events on their own without relying on the state. And the way they do that is by having access to financial services to smooth consumption and do other things. So access to savings, credit, to insurance. It's also linked to government agendas around driving economic growth through consumer spending. So a consumer, having financial services and especially having consumer loans and consumer credit enable sort of facilitate that agenda, because people can spend beyond their current savings and income streams. And that's sort of an important part of that. It's sometimes referred to as privatized Keynesianism. Can't really pronounce that word, but this refers to the economist Keynes, who argued that the state could stimulate growth through public expenditure. But this is really more that the consumer plays that role and spends on goods and services, and that boosts growth. So, but ultimately, enabling people to have access to financial services is not, necessarily only good. It also exposes people to risk by tying them into global capital markets. So there is a potential downside, and we saw some of that with the global financial crisis back in 2007, 2009. So you may be aware and you may not be surprised that there has been substantial amounts of research and a lot of ongoing research on this significant expansion of bank account ownership and financial service, sort of access to financial services. And I want to really highlight three key strands of that literature, which I think is relevant in this context and for financial inclusion more broadly. The first one is that there's a body of research that looks at what are the drivers and what's the impact of bank account ownership. And research has found, not very surprisingly, that people who are less wealthy, who are are lower incomes, perhaps are unemployed, who have lower educational attainment, and ethnic minorities or migrants are less likely to have a bank account. And that's important because there's research to show that bank account ownership supports, so it helps households increase assets and savings. It enables them to access credit and also other types of financial services. And generally, people who have bank accounts are more likely to engage with other terms of financial service products like pensions and so on. The second area relates to use of what we call non-bank financial services. So what are the effects of that? And again, what are the drivers? So those are services that are primarily aimed at people who are unable to access or use mainstream financial services. They are typically associated with higher fees and weaker affordability checks, in some cases also weaker regulatory checks. And it's important to stress that people quite often use both. So people have a bank account and then use non-bank financial services. So what the research has found here is that users of these type of services are typically on low incomes. They have lower levels of education and lower financial capability compared with those that don't use it. And there is some, although causality is a difficult issue here, but there is research to suggest that non-bank use of non-bank financial services, especially loans, is associated with lower financial well-being and greater financial difficulties. So, for example, greater likelihood of falling behind on payments and those types of things. The third and final area of it looks at the evolving financial infrastructure. So, bank branches in local communities and local areas. So, this has shown that the research in this area has shown that, not again very surprising, areas of low income and greater deprivation have fewer branches, but they're also more likely to be affected by branch closures, as well as in the States also failures of banks. That's important because I think especially evidence from the US suggests that residents in areas that have lower density of branches tend to be less likely to have a bank account, but also more likely to use non-bank financial services. There is also a large literature around point of sales payment methods. And I think this is a really critical body of literature that provides some insights and introduce really two key concepts around salience and transparency, which I'm going to be drawing on when I come to develop or outline my conceptual model. So, in essence, different types of payment methods have different levels of what we call salience and transparency of payment. At one end, cash is considered to be sort of the most transparent and salient payment method there is. So if you operate in cash, you can immediately see what you can spend, the amount you have in your pocket. When you spend something, you might have to count out what you spent. So that's a really sort of visible, tangible thing you're doing. And the person giving you the money, but giving you your change back, will also have to may also count back to you what they're giving you. So it's an immediate indicator both of what you've just spent and what you have left. So super transparent from that point of view. Credit, debit cards, mobile payments, digital payments, they're really more at the other end. So they're less transparent. By that, we mean you can't immediately see the amounts being transferred or what you're not getting anything back in that sense. And you won't immediately see on your balance, perhaps, what is being spent. That's important because payment salience and transparency affects how people and how consumers perceive costs, but also how they perceive what we refer to as the psychological pain of payment. So Selimai introduced this concept of the pain of paying, which I think is a great term. And the basic rule of thumb is that the more transparent the payment method, the greater the pain. And that has some very significant implications in terms of how people behave. I'd like to highlight really 3 key sort of empirical insights relating to this. So relating to payment transparency. And so research on payment methods has generally found, I think there are 3 key findings. The first is that consumers are less likely to accurately recall their past spending when they use cards compared with cash. And cash is especially sort of preferred by liquidity-constrained households to monitor and control spending because they need very precise information about remaining liquidity or whatever they have left. Second insight is that, or finding, is that people are willing to pay more for the same goods when they're using payment methods with lower transparency and salience. The final finding is that from this body of work is that people have greater propensity to overspend when they're using cards and digital payment methods. So some fairly significant implications. So if we take these 2 bodies of literature together, I think they provide some really critical insights about this very significant shift in how we pay and manage our money. But it doesn't give the whole picture, and in terms of what that means for behavior and outcomes. If we start with the payments methods literature, that does give us an insight about what is the impact of cashless transactions on behavior and outcomes. And I've outlined some of those. I think an important limitations of this literature, it only looks at point of sale purchases. So what you do over the counter or what you might pay on Amazon or whatever. So it doesn't take into account payments of larger ticket items such as bills and rent, where you might use other means of payment. So you might use automated payments or you might use bank transfer. The financial inclusion literature is incomplete, or I think one of the major drawbacks of the financial inclusion literature is that it doesn't actually tell us. It mainly looks at ownership rather than use. And in the cases where they do look at the use of financial services, I would argue that they are using some fairly arbitrary or at least generic measures of use. So how many transfers have you done and so on. So really, we can't use this literature. It doesn't tell us whether people are worse or better off managing their finances digitally, because owning a financial product is not the same as using it. And this is especially the case for low-income consumers. I did a survey a number of years back of low-income households in the north of England and find that although 90% plus have a bank account, or pretty much all of them have, a significant proportion don't use their bank accounts actively in how they manage their finances. So I want to dedicate some of the rest of the time I have to outline what I think could be a broad conceptual model for theorizing how this shift from cash to digital money management may influence household financial behavior and outcomes. The model I present sort of theorizes or conceptualizes that the use of banking services to manage finances influences the level of financial control through these concepts of transparency and salience, and that the level of financial control affects household behavior, including propensity to save and overspend, and that in turn influences household outcomes in terms of well-being, but also making them more liable to incur bank fees. So this really is an extension of some of the point of sale payments literature insights to a wider range of payments and money management sort of methods. I'm going to go through each of these elements in turn. So alluding to, so previously I said that I think the financial inclusion literature uses some fairly arbitrary, or at least some generic measures for how to measure use of financial services. I would argue that there are sort of three levels of use of electronic banking services or digital banking services. The first one is point of sale purchases. So these are the over-the-counter everyday transactions you make. That's sort of fairly elaborately dealt with by the payment methods literature. The second type is around electronic transfers and payments. These are non-automated payments that that you can use to, pay bills or settle up with friends or whatever it might be. And then the final type of payment is automated transfers. So these are critical, certainly in the UK, to build your credit score and improve access to other financial services. But you are at the risk of incurring fees, because if you don't have enough coverage, you can't then if you go overdrawn, you'll bill fees. And it's also complicated because it can incorporate varying fees depending on use, varying amounts, so they might not be the same. So this generally hasn't been preferred by low-income consumers. Key for all of these is that they are associated with lower levels of transparency and salience compared with cash. So just traditionally, the way a lot of UK low-income households would manage their money is that they would be paid into a bank account, they would take that money out, and they would then allocate the spending, perhaps using envelopes or even jam jars or whatever, and prepayment methods. And they could therefore clearly see what they were spending where and what they had left. So in line with the payments methods literature, I theorized that digital or electronic money management reduces control, because reduced salience and transparency reduces accuracy of it reduces the pain of spending and reduces accuracy of monitoring. So weakens planning by removing the pain, reduces accuracy of monitoring of spend, and increases also the propensity to overspend. So I identify these three dimensions of financial control in terms of planning, monitoring, and then controlling. Finally, the model sort of theorizes that lower levels of financial control influences household behavior, so increases the propensity to overspend and making it more difficult to set aside money. And in turn, this may affect financial well-being, because being in control is one critical component of the financial inclusion, of the financial well-being concept. Also makes them more likely to incur costs, bank fees, sorry. Now, this is clearly just a small sort of simplified model. There are lots of other explanatory and intervening variables, which I don't really have space or time for to go into here. Like, I think liquidity constraint is clearly one important intervening factor, because if reduced accuracy in monitoring is less important, if you are less liquidity constrained, you have more room to maneuver. And similarly, if you have high income volatility, you're at greater risk perhaps of overspending and reducing propensity to save despite of financial planning. And other factors are financial literacy and digital skills and so on. So to conclude, I think I would say it's fair to argue that this shift from cash to digital is perhaps one of the most significant recent changes in how households manage their finances, both in terms of scale, sort of millions of people opening up accounts and starting to manage their money this way, and scope, so covering everything from how we settle up with friends through to how we pay our bills and rent, and how we receive payments and so on, and how we pay for goods and services in everyday life. The research on point of sale payments point to some what I would see as fairly radical, at least very significant implications of that shift, in that it's been found to reduce accuracy of monitoring, decrease price sensitivity of consumers, and increase their propensity to overspend. And as always, low-income consumers and households are particularly affected. That's a particularly, and that sort of explains part of their aversion towards moving away from cash and using digital or electronic money management. But really, in the whole, I think we know very little about the implications of this shift for household financial behavior and outcomes beyond point of sale payments, which is only one part of how we manage our finances. So in this paper, I've outlined a model, or suggested a model for conceptualizing some of these household level implications for behavior and financial outcomes. And there are sort of three key points, I think, from that. One is that moving to digital electronic money management from cash reduces payment transparency and salience. This potentially results in reduced financial control, increasing the risk of overspending and reducing the propensity to save. And in turn, if you overspend and save less, then that will have obvious implications for your financial well-being, and also, I think, the overall loss of financial control mean that you are likely to incur inadvertent bank fees. I would say that, unless we know more about who are better off or worse off managing their money digitally and why that is, whether that's skills or whatever it is, unless we know that, we can't really come up with any effective solutions or ways to support people. whether that we don't know whether we need to provide more suitable products or whether we need to do more to preserve the cash infrastructure and the ability to use cash as a way of payment. So I think we really need more research and policy work. I think there are 4 areas that for me that crystallize. The first one is we need some more basic research around how households use financial services and overall money management. And I emphasize use because use, looking at access and ownership is not the same. That's access and ownership is different from use. You can own something but not use it. Second area where I think we need more is really around around understanding how these transitions from cash to electronic or digital non-point of sale payments affect especially low income users, but users more generally. Thirdly, public and private sector are increasingly, in more and more areas, shifting to cashless payments. I think we need to understand more about what the impact of that is. And the final call for more research, I think, for me, is really around, I'd like to see more experimental research and methods to isolate what we think of the impact of non-point of sale digital payment methods on household outcomes and behavior. And that concludes my presentation. I have a bunch of references, which but you may have access to the slides subsequently. Well, thank you for listening, and do let me know if you have any questions. Any questions or thoughts? Anyone who's have any thoughts or questions about any of the dimensions I've talked about? Whether am I right in pointing this out? Are there other things I've missed out? So yes, I can see there's a question here from Rafal. Whether we're better off now or with just cash transactions. Well, I guess for me, there's sort of a big question about, I would say the short answer is we don't really know. I think we don't fully understand what this shift means. I think we know for the point of sales payments. I think we have some better idea. But I think for think more generally, we don't really know whether we're better off with cash transactions or digitally. But likelihood is that people on the lower income segments are likely to be to perhaps benefit less from the shift to digital. But again, yeah, it's an open question. Sounds like a good PhD questions, maybe. Okay, that's another comment. Yeah, that's we don't really need cash. So I think that's sort of increasingly true. But what's interesting, I think, is that there's some recent research from America and other in Europe that shows that that mobile payments are associated with greater overspending and sort of less financial control. So I think it's part of the question is how do we manage this transition, and how do we sort of support people to make financially sound decisions and enable people to monitor better or have greater financial control using digital forms of payment. So okay, don't think there's any more questions. So just thank you very much for the opportunity to present, and hope you enjoyed it. And I'll yeah. So thank you.